This is Jody Trana with Chapter 5, Part 1 of Principles of Accounting. Throughout this course, we've been talking about a business, Smart Touch Learning, that we started in November of our calendar year. Smart Touch Learning is an e-learning business that specialized in providing services such as business courses. It was started by Sheena Bright. Sheena Bright plans to discontinue all of its service businesses, and instead it plans to sell touchscreen tablet computers. This may not seem important, but as an accountant, this changes a lot. We've been working with service companies to this point. Those are the most simple type of business to do accounting for. Now we're going to switch to a merchandising company, which is a company that has inventory. This is a simple profit equation for service companies. The sales revenue minus the operating expenses equals the net income or the net loss. We've talked about this profit equation and how it is the basis for the income statement. Because the operating cycle of a merchandiser is different from that of a service company, the financial statements also differ, and that means our accounting processes need to change. On the income statement, a merchandising company reports revenues using an account called sales revenue rather than the account we had used before called service revenue. A merchandiser also reports the cost of merchandise inventory that has been sold to customers, or cost of goods sold. This is not everything that we have purchased in inventory, it's just the inventory that has been sold. Because cost of goods sold is usually a merchandiser's main expense in a business, we also want to calculate an intermediary profit number called gross profit. This number is determined before we calculate any net income. Gross profit is the excess of net sales revenue over cost of goods sold. After calculating gross profit, expenses are then deducted to determine our net income. Operating expenses are expenses of running the business, not the cost of goods sold. Take a look at how the service company's income statement on the left differs from a merchandising company's income statement on the right. You'll notice that we've added our extra account of cost of goods sold as our second item, and we have that intermediary profit number called gross profit right below it. The only other major change is that we're no longer collecting service revenue, we are collecting sales revenue. There are two main types of inventory accounting systems that help us keep track of the value of inventory that we have on hand. That's inventory that we have not yet sold to customers. A periodic inventory system is a system that requires businesses to do a physical count of inventory to determine how much is on hand. The system is normally used for inexpensive goods such as small local company, maybe a small coffee shop, or maybe a small company that has very few pieces of inventory, but they are large and expensive, such as a custom car manufacturer who only builds 1 or 2 supercars a year. A perpetual inventory system keeps a running computerized record of all merchandise inventory. That's the number of units that are in stock, the dollar amounts associated with that inventory, and everything is kept perpetually. That is, when something is sold, it comes off inventory. When something is purchased, it goes onto inventory. Computerized systems make this perpetual inventory system fairly easy for most businesses now. It still does require a physical count every year to confirm the account of inventory. We are primarily going to be talking about perpetual inventory systems and working on transactions that relate to our perpetual inventory system. The first transaction is a purchase of merchandise on account. We're going to be doing journal entries, so let's get started. Assume that on June 3, SmartTouch Learning purchases merchandise inventory on account. Before we do the journal entry, let's take a quick look at the invoice that SmartTouch Learning receives when they purchase inventory on account. Here we can see that they purchased touchscreen tablet computers, 100 of them, and they cost $350 a piece. The total cost for this inventory is $35,000. You can see that we purchased from Southwest Electronics Direct, and we can also find on here the payment terms that they have given to us. Here you can see marked with a number 4 the credit terms. 3/15, net 30 days. This means that if we pay this invoice within the first 15 days, we can claim a 3% discount. If we don't pay within the first 15 days, then the net amount of the invoice, the full $35,000, is due within 30 days. You can see that at the bottom of the invoice, number 7, they've also identified the exact dollar amount and taken this discount for us. The invoice is dated June 1. So if we pay this invoice by June 16, that's within 15 days, we need to pay $33,950. That's the $35,000 minus a 3% discount. If we don't pay that amount, the full $35,000 is due on July 1. That's 30 days from the day that we made this purchase. Before we start our journal entries, I want to show you one more thing. This is the current assets section of 2 companies' balance sheets. On the left, you see a service company balance sheet. That's the one you're most comfortable with. On the right, you'll see a merchandising company's balance sheet, the current assets section at least. There's one change to here that's important. We have a new asset, and that is merchandise inventory. It's listed right after cash and accounts receivable as our third most liquid current asset. Merchandise inventory represents all the inventory in our company that is sitting on our shelves and waiting to be sold. Now back to our journal entry. Assume that on June 3, SmartTouch Learning purchases merchandise inventory on account. The transaction description hints to our 2 accounts that we're going to use here. We purchased merchandise inventory, so that is our debit account that we're increasing. That's our new account that we just added that shows the inventory sitting on our shelves, literally or figuratively, that is waiting to be sold. On account gives us an indication that we haven't paid for it yet, but we need to, and that account is called accounts payable. We're putting the full $35,000 in as merchandise inventory and accounts payable because that's the full amount of the invoice. We may fully intend to take a discount, but we don't record that discount until we actually qualify for it. That's when we pay. Right now, we need to record the full amount of the invoice. We're going to play the if game for a minute. If SmartTouch Learning pays on June 3, that's just 2 days after they arranged for the purchase, they do not, but what if they do? The cash payment would be within the discount period. What would be the journal entry? Playing the if game, if SmartTouch Learning pays on June 3, this would be our journal entry. First of all, you remember we posted a $35,000 credit to accounts payable. So we need to clear that out if we make a payment. So our debit will be to accounts payable to clear that obligation. Next, we're going to be paying cash But wait, we're going to take a discount, so let's figure our discount first. Our discount is 3% of $35,000. That's $1,050. When we take that discount, we're actually reducing the cost of purchasing that merchandise inventory. Remember, our merchandise inventory was posted as a debit when we purchased it. If we reduce that purchase by taking a discount, then we need to reduce that account, and that would be with a credit. So we're going to credit merchandise inventory for $1,050. The cash account becomes the difference between those two numbers, between accounts payable of $35,000 and our discount of $1,050. We need to credit our cash account to show that we're paying that amount. Now that was just to play the if game, so now we're back to still owing that $35,000 for accounts payable. Before we pay it though, let's say that Smart Touch Learning returns $7,000 of the merchandise because it is damaged. What would be our journal entry? If we need to return merchandise because it's damaged, we in essence need to reverse our original entry for the amount of the damaged goods. We're not going to be taking possession of them, and we're not going to be paying for them. So we need to debit accounts payable for $7,000. That will reduce our original $35,000 credit that we did to accounts payable. And we need to reduce our merchandise inventory for the 20 tablets that we're not going to be keeping for $7,000. Let's play the if game again. If Smart Touch Learning pays for the merchandise on June 5, that is within the discount period, what is the cash payment journal entry? Don't forget that we've had to return some goods that were defective. So we need to debit accounts payable for $28,000. That's our original $35,000 credit less our $7,000 that we debited for damaged goods. Now let's go ahead and take our discount. The discount will be 3% of $28,000, not 3% of the original invoice. That's because we returned some of these goods. 3% of $28,000 is $840. Remember that when we take a discount, we're actually reducing the cost of our merchandise inventory that's been purchased. So we want to credit that asset account. The difference becomes the amount of cash that we pay. One of the ways you can be assured that your cash is on the correct side and of the correct amount, just make sure that your cash is lower than your accounts payable amount. And remember, whenever you're paying cash, it needs to be on the credit side. Let's take a break and talk about transportation costs. Either the buyer or the seller has to pay for the transportation costs of shipping the merchandise inventory to the buyer. The purchase agreement usually specifies FOB, which is free on board terms. These terms will determine when the title of the goods transfers to the buyer and who pays for the freight. Remember that with FOB shipping point, the freight cost is paid by the buyer. When we do that, we add the cost to the cost of the inventory. So let's assume that Smart Touch Learning pays a $60 freight charge on the June 3 purchase. We call that freight in. Because the cost of the freight has increased the cost of our merchandise, we're going to debit merchandise inventory and credit cash when we make this payment. Let's take a look at the accounts that we've been using for buyers and sellers. Both buyers and sellers have a new account, merchandise inventory. They also both have accounts for invoices for those items that are on account, accounts payable and accounts receivable. And of course, we have cash. But no company just buys, and no company just sells. Companies are both buyers and sellers. So we need to be able to do journal entries for both when they sell goods and when they purchase goods. When companies are acting as a buyer, they're only dealing with merchandise, accounts payable, and cash. But when companies act as sellers, they're dealing with much more than just merchandise, inventory, accounts receivable, and cash. They're also dealing with sales, sales returns, sales discounts, and cost of goods sold. Smart Touch Learning is now in the business of selling tablets. So of the $28,000 worth of inventory sitting on the shelf, they are tickled to have sold 2 tablets for a total of $1,000 in cash. Remember that the tablets cost us $350 a piece, so 2 tablets have a cost of $700 total. When we sell things as a merchandise inventory company, we have to record both the reduction of our merchandise inventory and the sale of the merchandise inventory. First, let's post the sale. Since this was a cash sale, we will debit cash for $1,000 and record sales revenue for $1,000 credit. Now for the inventory portion. We need to acknowledge that 2 of our tablets are no longer in inventory. They cost $350 a piece when we purchased them. So we will be crediting our merchandise inventory account for $700 to reflect those tablets no longer being here. We debit the account called cost of goods sold. This will show up on our income statement as a reduction to our sales revenue of $1,000 to show a gross profit of $300 on this sale. Instead of cash, the next sale that Smart Touch Learning makes is on account. This is for 10 tablets that are sold for $500 each. They have given the terms of 2, 10, and 30. That means a 2% discount if it's paid by the customer in 10 days. If not, the net of the invoice is due in 30 days. This all happened on June 21, and the cost of these goods is $3,500. Whenever we make a sale, we have 2 journal entries that we need to do. One is going to record the sale, and one is going to adjust our inventory. The journal entry to record this sale is a debit to accounts receivable. That shows that a customer owes us money and we're likely to receive it within 30 days. And a credit to sales revenue to record that revenue. To record the reduction of inventory, we will credit merchandise inventory and debit cost of goods sold for the amount of goods that have been sold to a customer. Remember how we returned $7,000 worth of goods because they were damaged? Well, it works both ways. Now we have a customer who returned 3 tablets that were sold to them on account. They've returned them for the value of $1,500, but our original cost of goods sold was $1,050. We need to reverse this sale, and we also need to reverse our reduction of inventory because we're going to put these tablets right back into inventory. When items are returned to us and we need to reverse a sale entry, we do not want to debit directly into our sales revenue account. So we have a contra revenue account called sales returns and allowances that we will use. We're going to debit that account for $1,500, and we're going to credit accounts receivable to reduce our accounts receivable amount. We also need to reverse the previous reduction of merchandise inventory, so we're going to add this back into inventory by debiting merchandise inventory for $1,050 and crediting cost of goods sold because it is no longer sold. Our final journal entry is for a sales discount. Let's assume that the customer that purchased the tablets on June 21 made their payment within the 2% discount period, so they're going to take that 2% discount when they make their payment. I'm going to start from the bottom. The $5,000 for accounts receivable, that's the amount that we originally posted into accounts receivable as due to us from this customer. We need to make sure that that entire $5,000 is reduced out of accounts receivable, showing that it is no longer owed to us. So we're going to credit the full $5,000 to accounts receivable. The next thing that I will work out is the sales discounts. We offered a 2% discount on the sale amount of $5,000, so that is $100. That sales discount is going to reduce our overall sales revenue. Again, we don't want to use sales revenue directly, so we're going to use another contra account called sales discounts. We're going to debit the sales discount account for $100, and the net amount between these two is the amount of cash that we received for $4,900. You may be thinking, where do these contra revenue accounts show up? When we do an income statement, both accounts will show up as a reduction to our sales amount to create a net sales on our income statement.